Hi, welcome to this webinar. In this webinar, we're looking at industry attractiveness and why you should select a particular industry when starting out. So, first of all, at the REU here, we think about agriculture and food and drink as two sectors. Agriculture is very much of the farm and the farm gate, and the food and drink is the industry that sits after that typically. So when we look at these two industries, they have different GVAs that we see. So gross value added, which is a productivity measure of value for the economy. So when we look at the GVA for the agricultural sector, we see that agriculture in the UK is typically about 0.6%. So it's a very, very small aspect of the total GVA of the economy. To put that into some context, if we look at a country like India, India has about 14.3% GVA as part of the agriculture. Services is about 54%, and the rest of the industry, which is all the other colours on that graph, is about 31% for India. So you can see the UK is predominantly a service-led economy. If we think about the GVA for the food and drink sector, this is about 17% of the total economic GVA for the UK. So when you look at those two sectors, you could see that it's probably, if you're looking for investment, better to be in the food and drink sector because it's a bigger sector, but also it's a bigger growing sector within the UK. We tend to export more value-added products than raw materials because raw materials are have a better product, a better tax and a better sales value. So when we look at typically the agricultural and the food, that's why we see a lot of farms are diversifying and moving up and down the value chain. And that is giving them a better productivity, a better profitability, but also a better investment potential. Not all industries fare well over a period of time. So you can see in this graph, really we're looking from the last recession, so the 2008-2009 recession. And what we can see here are certain industries have fared better than others. You can see initially the business services sector dipped quite considerably and then picked up really well. But other sectors like public administration, so the government has kept itself very small over that period of time. The expenses within that have been kept low, but also you can see the financial and insurance sector hasn't really picked up since those days. So you can see real estate's done well, health and education's done well. So not all industries are on a similar growth potential and a growth trajectory. So swapping industries or changing your industry to one that has a higher potential or higher growth is a better strategy for you when starting out. Certain sectors have different performance. Now here I like to think about productivity. Certain industries have better productivity than others. Productivity is generally aligned or correlated with the ability to trade internationally, because better productivity reduces your costs, which basically means you can increase your profits or you're a bit more flexible on your pricing. So here you can see a whole series of sectors really from May 2020. And as you can see here, certain sectors over this financial year or the last year have really suffered due to COVID-19. Whereas other sectors have really increased. So what you can see there is health has really increased. And you can see others such as bars and restaurants and hotels really decreased. So again, if you looked just within the food and food industry, you could see that the retailing of food in a physical location has decreased, but actually the production of food has actually increased. And I would argue that if we had a sector in there that was food delivery, you would probably see them right off the top of the scale there. So the performance over the last 6 months of some industries have really been drastically different, but their productivity is also increased. When we're looking at investment, people that invest have certain criteria. And one of them, of course, over the last 6 months has come to the front is inclusivity. So how inclusive is certain industries? And as you can see here, agriculture on the bottom left-hand corner is not one of the most inclusive sectors, whereas the information technology or the professional scientific technology sectors are very inclusive. So those guys have got both inclusivity and industry growth within the period that we look here. And therefore, they are good sectors to be engaging in a financial return because you're investing both in people, but also in technology. So this is also an interesting set of criteria to place yourself in industry. One of the things that we see here is this is a business angel investment graph from 2016 to 17, and it's breaking it down by sector. And again, what's interesting here is over the last 6 months, the sectors which have been invested in have come very well, have tracked very well through the COVID-19. So what we can see here is the top one there is health care and digital health. It's so obvious that they've done very well through COVID-19. Pharmaceuticals done extremely well. Financial technology or fintech, that's doing well as the world is more globalized and payments need to be moved across the globe. And software as a service, I'm talking here through Zoom. It's a software as a service. Everything has gone towards being more of a service. It allows people to work from home and everybody have the same software as a service. So that's very much on trend. And then finally, their e-commerce, digital media and content. You know, the video streaming services that we're seeing are very much in vogue at the moment as people are spending more time at home. So what you can see with that graph is even in 2016, 17, people were thinking about sectors that would be robust through a series of disruptions. And those disruptions, for example, COVID-19, has shown that these selections of industry sectors are very, very much needed through a disruption. So this is really interesting. So over these 4 graphs now, we've looked at which services are growing, which sectors are growing, what performance they have in terms of productivity, how inclusive some sectors are, and how robust some sectors are to both growth and also the attraction of investment. Typically, what we use is a model. Investors use a model that we call the 7 domains. It's been developed by John Mullins, and these 7 domains show how we can measure and analyze a business and look at both the internal and external factors. So first of all, here we look at the industry attractiveness. Normally we'd use a Porter's 5 forces model for this. Then we would look at the macro level, the micro level, looking at the assessment of the sustainability of the proposed new firm's competitive advantage. And this would be what proprietary elements do we have, and what superior processes we have. So if you think about if we are looking at an industry, so let's assume it's fast food, and we then say, right, we're in the fast food sector, then clearly the processes are the USP that we should have. So we need to be able to produce a consistent product every single time, 24 hours a day. And that process is our USP. And of course, the example would be McDonald's and how they can produce a hamburger in every single location consistently. Then if you look at the macro level of the market, now what we've looked at is the industry, but the industry serves a market. So here we're going to look at the scale of the opportunity. When I talk to people about starting a business, I will start looking at the beachhead marketplace. So this is the first customer group that we can address, and that first customer group has to be somebody that's easily identifiable. They can be addressed with a market need, and that market need is easily related to the product. And when I say easy related, I mean we don't need to do any form of education or re-education. It's something that those customers will naturally want to take on board, because if there is a form of education or re-education, then we would have to spend money and time getting those customers, and lots of startups don't necessarily have that. Then we look at the volume that we have there. So the beachhead marketplace needs to provide us with enough customers to get us started and get our cash flow moving. But ultimately, the larger marketplace has to be big enough for us to sustain the business completely. So it's moving from first marketplace to second marketplace. And what trends are we looking? So the trends that we have within the industry and the trends that we have within the market may be different. So there are industry trends with our competitors, and then there's market trends with our customers, and it's working those things out. And of course, each country may have a different social, cultural, economic trend. Then we look at the micro level for the market, and here we're looking down at the segments. So we've got different segments and how we can differentiate to our competitors. Now, we always try not to differentiate on price, so we're differentiating on benefits, on product specification, and here we're looking at how we access those segments. And finally, we have the team domain. The team domain is the domain where we're looking at the team and what those team can provide. So the first aspect is, does the team have similar aspirations? So, and do they have similar risk propensity? If they have different aspirations, then they'll go their separate ways. If they have different risk propensities, then some people will want to take a more riskier strategy. Some people will want to take a more safer strategy, and that leads to fragmentation of the team. We also look at whether the team understands the critical success factors. So those critical success factors, we need to align with both ourselves as an investor, but also do the team align them. So, identifying what is critical to become successful, and ensuring that they have a risk management strategy to enable them to achieve those critical success factors. And finally, bringing it all back to the industry sector, these guys need to be connected up and down the value chain, and that predominantly means they need to be connected within their industry. Finally, in this presentation, we have looked at why we should select an industry, and that may be based on the sector performance, it may be based on inclusivity, it may be based on the investments that are being made at this current time, or it might be investing in sort of the micro and macro trends that are happening around us. So placing ourselves in a growth industry has a better potential for us to move forward and grow our business. It also gives us a better opportunity to gain investment. And we did look at different sectors which are more robust to disruption than others. By selecting an industry, it gives us a set of competitors, and that gives us a set of benchmarking, and benchmarking allows us to set processes and set productivity and set profitability expectations, which is very important when starting a business, because how do you know you're being successful? It's only by comparing yourself to other people. And ultimately, you're then benchmarking yourself to best practice and the global trends. I'd like to thank you very much for listening to this webinar, and I look forward to seeing you again. Thanks.